Welcome to the Deep Dive. Today we're really getting into the mindset of a legendary Indian investor, Vijay Kedia.
That's right. We're using excerpts from his interview on the money mindset with Sonia Shenoy as our guide.
And our mission really is to pull out the core ideas, the actionable stuff behind his long-term success.
Exactly. Aimed at you, the learner, getting those key insights, those aha moments without it feeling too heavy,
Definitely. So Vijay Kedia, we're talking 30, maybe 40 years in the markets.
Yeah.
Known for a focused portfolio.
Yeah, usually around 15 to 20 stocks. And he's got these other interests too, like singing, poetry, not just finance.
Which is interesting in itself. One thing that struck me early on was how he talks about his net worth, or rather, how he doesn't track it.
Right. He says he relies on media reports, uses that analogy of running a marathon.
Yeah, focusing on the finish line, not counting every kilometer you've passed, seems like a very long-term view. What do you make of that?
I think it signals that detachment from the day-to-day noise immediately. It fits with his story, too, starting so young.
At 14, wasn't it? Driven partly by struggling academically.
Yeah, he failed his 10th grade, his father passed away, and suddenly he needed to support the family. Started with SATA, like speculation, with almost nothing.
And then moves to the actual stock market floor at 19. Imagine that, the trading pits. So different from now.
Totally different era, and apparently not much family background in it either. His grandfather was a broker, but hadn't made a fortune.
And Kedia himself wasn't keen on the brokering side, the client management aspect.
No, he mentioned feeling uncomfortable with the whole buttering up clients thing. He wanted his own way.
That independence really comes through, even getting kicked out of his house by his uncles for speculating.
Which he called a blessing in disguise. Gave him freedom, the whole ocean to explore, as he put it.
Then he lands in Mumbai, late 89, early 90, and boom, the bull market kicks off right after.
Talk about timing. He said it turned his fluke into a tear, an arrow hitting the target. Made him feel like a king.
But he looks back on the struggles as adventures, learning experiences.
He does. And he gives credit to the bull market, being in the right place, right time. Attributes it to Ishwar, God's grace. There's a humility there.
Absolutely. But okay, let's move past the early luck. Because there's clearly skill involved, right?
Yeah.
Especially his focus on small and mid caps and this SMILE framework.
Yes, this is where we get into the real mechanics of his approach.
So that luck versus skill idea first. He thinks luck gives you lessons.
Yeah, basically luck can give you a win without skill, but the experience you gain from that lucky break becomes skill. It prepares you for when luck isn't on your side.
So luck provides the opportunity, experience provides the sustainability. Makes sense.
And that ties directly into why he likes small and mid caps. He believes they can become multi-baggers faster than the big giants.
The elephant versus the deer analogy, right? Elephants turn slowly.
Exactly. Deer, cheetahs, ants, they're nimble. And he felt he was playing catch up, so he wanted that faster potential growth.
Okay, let's break down SMILE. S is for small in size.
Right, but not necessarily the absolute smallest. He means smaller players within a sector. His mid-cap definition was around, 35,000 crore market cap?
Gives you a ballpark. And remember, a crore is 10 million rupees for context. Okay, M.
M is medium in experience, the management team. He looks for about 15, 20 years under their belt.
Why that specific range?
Because they've likely seen multiple market cycles, navigated tough times. He tends to avoid very new, untested management. Experience counts.
Got it. Then the Alvate is large in aspiration, management ambition.
Yes, crucial. He needs to see that hunger, that fire in the belly to grow the company significantly. From, say, 1,000 crore to 5,000 crore, maybe go national, international.
Without that drive, you don't get the exponential growth. Makes sense.
L is for extra large market potential. The company's product or sector needs a huge runway for growth.
The pond versus the ocean analogy.
Don't hunt the crocodile in the pond, hunt the fish in the ocean. Yeah, target businesses with almost limitless market space.
And E. It's not a letter, more a philosophy.
Exactly. It relates to navigating market cycles. His famous line, "We are neither in a bull market nor in a bear market. We are in the stock market."
So he sees the overall economy as the real indicator.
Pretty much. The Indian economy is the foundation. He doesn't obsess over bull-bear labels.
How did that translate into action then?
Well, he tends to pull back, get defensive when things get too frothy, too much hype.
And the opposite in downturns.
Exactly. He gets offensive, looks to invest more aggressively during crises.
He had that quote, didn't he, about where real wealth is made.
Yes. Whoever has made money in the world has made it by investing in the bear market. You have not created much wealth by investing in the bull market.
So making money versus creating wealth. Wealth creation happens in the tough times, like post-COVID or other crises.
That's his view. He also noted a shift, maybe post-2003, where bear markets seem shorter, bull runs longer.
But he cautioned that a new high isn't always a sign of a healthy bull market, right? Could be dangerous.
Yeah, he mentioned getting good returns between 2008 and 2012, even though it wasn't seen as a huge bull run compared to later periods.
He sees bear markets as filters, weeding out the weak.
Kind of like a cleansing process. He thought the post-COVID correction was a good lesson for newer investors. The moving train analogy, you find out your strength when things slow down unexpectedly.
And that Hindi proverb captures the volatility perfectly.
Pagwan data hai, tu chaparfad ke data hai, jab leta hai, tu tapad mar keta hai. God gives abundantly, but takes back with a slap. Sums up market swings.
Okay, so moving on to holding strategy. Patience seems key. That quote about the story.
Chase the story behind the stock, not money on the table. Money will make you rich, but story will make you wealthy. That's pure Kedia.
It defines his long-term view. He's not chasing quick flips.
Not at all. He'll hold even if the price goes nowhere or down, as long as that core story is intact and management isn't messing up.
Like a Tulato, holding through that flat period from 2020 to 2023.
Exactly. No fixed holding period. Multi-baggers take time. Years, often.
And the Sarah Sanitariware example is just staggering. 16,000 times return.
Include dividends, yeah. Based on a near zero cost basis over, 18 years, shows the power of one great idea held with conviction. No price targets, no time limits.
I like his bouquet of flowers analogy for the portfolio.
Right. Different flowers bloom at different times. Overall portfolio health is what matters. He tolerates underperformers if the management and story are still sound.
Let's dig into Sarah. How did he spot that one early?
Well, few listed players back then, Sarah, EID Perry, Hindustan Sanitaryware.
And India's growth, the housing boom, those are big tailwinds.
Definitely. Plus, Sarah looked cheaper, lower PE ratio than peers.
And he got that personal validation from his cousin, the developer using their products.
Yeah, that boots-on-the-ground feedback helps build conviction.
Plus that EID Perry deal selling Roca.
Right, at a valuation that made Sarah look significantly undervalued by comparison, like 4 times cheaper on a sales multiple basis.
And he held through the boom, took some profits, but the final exit wasn't until 2023, after 18 years.
Incredible discipline, truly long-term.
So looking ahead, he talks about India's Amrit Kal, a key decade.
Yeah, the next 5 to 7 years being crucial for structural development. He sees India in its adolescence moving towards maturity.
And he thinks that per capita income hitting around $3,000, $3,200 could be a major inflection point for consumer spending.
Potentially sparking a big boom maybe in the next year or so, he suggested. But his preference is contrarian.
Looking at sectors not currently hot, wary of trends.
Exactly, like tourism. He sees it as underpenetrated in India, despite the potential.
Acknowledges the challenges, though, infrastructure, hotels, access.
But sees potential with the government pushing domestic and religious tourism.
He mentioned owning Mahindra Holidays, but not thrilled with it yet.
Yeah, held it 4 years, no big returns, thought it was expensive, maybe some management weakness, issues with a Finnish subsidiary. Definitely not a recommendation, he stressed.
But also owns Indigo, the airline, as a broader tourism play.
Right, and mentioned IRCTC as another possibility.
What about other future themes? EVs.
He mentioned a tool auto for three-wheelers and precision camshafts.
Precision camshafts is interesting, using profits from old tech camshafts to fund new tech, EV retrofitting.
Yeah, retrofitting buses, LCVs, SCVs, a smart transition strategy. But he noted both stocks looked expensive at the time. Precision gave him a 3-4x return in 3-4 years, though.
And then PSU banks. He finds them attractive now.
Very attractive, apparently. Low valuations. Said he'd almost rather buy a whole bank than just take new stock positions right now. That's a strong value call.
Wow. Okay, shifting gears. Risk appetite. He thinks it's innate, God-given.
Pretty much. You can refine it, manage it, but you can't fundamentally change it. Like, you can't coach anyone to be Usain Bolt if they don't have the natural speed.
The Kipchoge analogy, too. Elite talent is partly inherent.
And his own story, mock trading huge volumes as a kid, showed his natural inclination for risk, admits there's a thrill-seeking element for him.
So how does someone with that appetite handle downturns emotionally?
The train journey analogy again. Churchgate to Borivali. Focus on the destination, the company story. Don't jump off because the train slows down.
So price drops are okay if the story's intact, even big ones like Sarah falling 75% multiple times.
That's what he implies. He stayed put. He does book profit sometimes, but not necessarily driven by market falls.
And he hates holding cash.
Yeah.
Feels out of the game.
Yeah, wants to be invested. It's that marathon mindset again. Volatility is just part of the race. He's seen it all before. Stocks soaring and crashing.
His focus is the long-term record. But what if the market's up and his stocks are falling?
That's when he investigates. If the market's strong but his pick is weak, something might be wrong with the company or the initial thesis.
Does he rush to sell them?
Not necessarily. He starts paying much closer attention. He finds management doesn't always have the clearest view, so he relies more on observing market demand for the product.
Like with Kodak Bank underperforming despite good fundamentals, maybe it was just overvalued before.
That was one possibility he floated. Contrasted it with Tejas Network's years of losses, then a huge multi-bagger.
Driven by Jio's 4G rollout and orders.
Yeah, huge order book potential. He'd held a small position through the bad times. Shows his willingness to hold if the turnaround story emerges.
He accepts some won't work out. Jehorai, Seblilahai, it's all part of the play.
Diversification helps too. And he uses that Abhimanyu analogy, knows how to get in, but maybe not always how to get out perfectly.
Exit timing is hard. Regret is the lifestyle disease of investing, he said. No magic formula.
Stick to the core principle, chase the story, maybe sell a bit sometimes for peace of mind or risk management, but better to stick with conviction than constantly jump ship.
Okay, for younger investors, he offered the formal framework. Interesting, he admits he hasn't read investment books.
Yes. So F is focus. Investing is the center of gravity. Even at a Coldplay concert, his mind goes back to the market.
O is observation. Crucial for spotting trends, changes, like Q-commerce.
R is risk-taking capacity. Know yourself. And sees low-risk opportunities when they appear, the cricket no-ball analogy.
M is marathon mindset. Long-term view. Pick stocks with distant destinations.
K is adaptability. Adjust to market weather, boom, bust, flat, don't get rattled.
And L is love for the market. Passion beyond just money.
Seeing God in the market. It implies constant engagement, aligning all the other formal elements. His work week is 168 hours, he says.
Which leads to his thoughts on the 90-hour workweek debate. He sees a difference between founders and employees.
Big difference. A CEO's commitment is tied to the company's fate, potential huge rewards like stock options. An employee's growth is usually more linear.
So expecting 90 hours from employees without matching rewards is illogical. Bukit Fajan Nahoye Gopala.
A hungry person can't worship. Basic needs and fair reward come first. Makes sense.
Now, China. He invested in Chinese ETFs.
Right.
Calls China the first wonder of the 21st century.
He does. Encourages visiting. He had that experience in 2014, saw the pollution in Beijing.
And it sparked the idea for Sudharshan Chemical back in India.
Yeah, connected the dots, met people who confirmed Beijing chemical plants were closing, and Sudharshan was already on his radar for years. Bought it cheap during that trip. Observation again.
He also noted China's dominance in raw materials for future tech, solar, batteries, hydrogen.
And their export scale, like 6 million cars this year, believes India can learn from China despite political differences and democratic delays like the bullet train project.
So why the ETFs?
Evaluation.
Partly. Hang Seng Index was still low, around 18,000, similar to its 2008 peak, despite China's growth. Saw it as maybe catching the train early, unlike India's big run-up.
And ETFs avoid the risks of direct investing in China. Data issues, political risk.
Exactly. Let the fund managers handle the specific stock picks via ETFs listed in India on NCBC.
Okay, what about crypto? He thinks the dying time is over.
Yeah, if it was going to die, it probably would have by now. The cat with 9 lives analogy.
Would he invest? If it were legally listed and regulated in India, yes. He sees the global trend of countries starting to regulate it. Admits FOMO, but follows local rules when in Rome.
All right, wrapping up. Biggest success? Failure. Lesson. Successes. Sarah, Tejas, Atulado.
Lesson from winners. Tiraho, stay put, chase the story.
And he doesn't really do regret, accepts past decisions based on info at the time.
Pretty much. Considers what he got as destiny, forgets what he lost. Zindagi ke saath nibhata chala gaya, just kept going with life, believes decisions shape destiny.
What about learning from other greats like Chinuala, the Damanis?
Learns by observation like Ekalavya, sees the common thread, finds stories early, hold long-term, marathon, not sprint. reinforces his own approach.
The bamboo tree analogy: slow start, then rapid growth. Enjoy the journey.
And fundamentally, he leans towards value, but looks for growth within that value, willing to wait 10 years if needed, like betting on an injured star athlete recovering.
That Sudharshan chemical story, again, 15, 20 years on the radar, small buy in the 90s, held small for years.
Trusted the management, saw them as leaders. Then the Beijing trip was the catalyst, the body jolly moment. Patience paid off.
And Tejas Networks bought around 150. It fell hard, held a bit. Then the post-COVID 4G boom, driven by Geo, plus government support and the Huawei ban.
Saw the valuation comfort despite the fall market cap versus cash order potential. Took the risk. Believed in the 2G C4G leap. Said you need loss-taking capacity to make big profits eventually. Ignore the noise.
And finally, market leadership isn't a strict rule for him.
No, Atulado wasn't necessarily number one. It's more bottom-up management potential of the specific story.
So to boil it down, long-term marathon vision, chase the story, patience, adaptability via formal, and real passion for the market.
Absolutely. And for you, the learner, understand the business, be patient, develop your own style, and recognize that long-term conviction can yield amazing results.
And that final thought from Kedia himself, describing himself as a work in progress. It's a great reminder, isn't it? Learning never stops in the market.
Doesn't matter how successful you are. Continuous learning, adapting, keeping that long-term view.
A perfect note to end on. Thanks for taking this deep dive with us.